Hey y'all, welcome back to Money Mondays. Today we're going to talk about credit scores. A credit score is a score between 300 and 850 that potential lenders use to determine whether or not you would be a good person to lend money to. Basically, the higher the number, the less risk that lender is going to have in lending you money. And as a result, you'll be rewarded with typically lower interest rates. Some factors that are used to determine your credit score are your payment history, your credit history, credit usage, total balances, available credit, and credit checks. Now, it's important to understand that not all factors are created equal. Some factors carry much more weight than others in determining your credit score. So let's go through them one by one, starting with the one that is most impactful. Coming in at number one is your payment history. Your payment history makes up 40% of your credit score. So it is so important to make sure that you make those payments on time. Any payment that is late by 30 days or more can be reported by the lender as being delinquent. And unfortunately, even one late payment can have a significant negative effect on your credit score. Even worse, these late payments can linger on your credit report for 7 to 10 years. So you want to make sure that above all else, you are making timely payments to all of your debts. The next two factors that are nearly tied for being second and third most important in factoring your credit score is your credit history at 21% and your credit usage at 20%. Your credit history basically tells a lender how long you've had credit, how long you've been borrowing money. Now, it's not so cut and dry though. Some reporting agencies take an average of the amount of years and months that you've had credit. So let's say, for example, you opened a credit card 10 years ago, and then this year you open another credit card. Well, they're gonna take the 10 years and the 0 years and average them out so it looks like your credit history is actually only 5 years instead of 10. So it's important not to continually open new credit cards every single year if you want to maintain a good credit history. It's also important to be aware that you can lose some of your credit history if you don't use your credit. So if you have that 10-year-old credit card and you've just been keeping it open to maintain your credit history, but you never use it, that credit card company can close your account, thus removing that history from your credit report altogether. So even if you don't want to use a card, you might want to make a purchase at least once a year or so just to keep it active and avoid it from being shut down. Credit usage is calculated as the percentage of available credit that you have spent. So for example, if you have a credit card that has a $10,000 limit, then that means you have up to $10,000 to spend on that credit card. So if you spend $5,000, then you have a credit usage of 50% of your available credit. At this point, I've covered the top 3 factors that make up 81% of your credit score. I'd like to stop the video here because I think if you can focus on mastering these 3 factors, then you're going to be well on your way to an excellent credit score. I'll cover a little bit more in some follow-up posts, so be on the lookout for those, and I'll see you next Monday.